Central banks will once more be centre stage in the week ahead. We have to wait until the 11th of May for the Bank of England's latest monetary policy pronouncement, but the US Federal Reserve and the European Central Bank will set the tone on Wednesday the 3rd and Thursday the 4th of May respectively. In an attempt to head off inflation, the Fed has rushed its headline funds rate up from a record low of 0.25% to 5% in the last 12 months, the fastest upward move in US interest rates on record. J.J. Powell and his colleagues have also sanctioned a switch from quantitative easing, QE, to quantitative tightening, QT, by ceasing the central bank's bond buying programme and permitting its fixed income holdings, and thus its balance sheet, to shrink at the rate of $95 billion a month. That's not expected to change at this month's meeting of the Federal Open Markets Committee, but Mr. Powell and colleagues are expected to hike the Fed funds rate by another 0.25% to 5.25%. Now, the real issue then is what hints Mr. Powell drops as to future policy moves. Inflation may not be cooling as fast as the Fed likes, and labour markets remain tight, given how low unemployment is. But the US banking system's had a wobble, and the central bank is now admitting that a recession's possible this year. That leaves the Fed with a tricky balancing act, and markets currently believe this will be the last rate hike of this cycle, and indeed markets are already pricing in the first rate cut for November 2023. Having been late to start raising rates, the Bank of England moved in December 2021, the Fed in March 22, the European Central Bank only got into the act on July 2022, but now it's been busy catching up. President Christine Lagarde and colleagues have taken their base rate, or main refinancing rate, from 0 to 3.5% via a series of quick-fire hikes. The ECB's also started to shrink its balance sheet. Last autumn, it started to collect repayment of the cheap financing it provided to European banks via the targeted longer-term refinancing operations, or TLTROs, and in March it started quantitative tightening at a rate of €15 billion a month. That rate of QT is due to run until June, at which point the ECB will reassess, while the consensus is the central bank will take the refinancing rate to 3.75% at this meeting, and then 4% or even 4.25% before pausing in the second half of the year. More than a dozen FTSE 100 firms are due to publish results or trading statements in the coming week as well, and another 10 or so will be hosting their annual general meetings for shareholders or on Analyst Day, so we have a very busy week ahead of us, despite the bank holiday shortened week, especially once mid and small cap releases are added to the mix. Companies which may be worthy of further study include the following, although note that some of these dates could yet be subject to change. BP and Diversified Energy on Tuesday the 2nd of May, Lloyds, Barrett Developments, Flutter Entertainment, Coca-Cola HBC, OSB, TI Fluid Systems on Wednesday the 3rd of May, when Intertek will host an analyst meeting. Then we have Shell, Next, BAE Systems, Hiscox, Derwent London and Aston Martin Lagonda on Thursday the 4th, and International Consolidated Airlines and Intercontinental Hotels will round out the week on Friday the 5th of May. But even allowing for that extensive list, the company which may cause the biggest fuss in the week ahead is HSBC. The megabank is due to release its first quarter results to the end of March on Tuesday the 2nd of May. The shares are up by more than 10% over the past year, and also by that much in 2023 alone, which may surprise some of you given the wobble seen in the US banking system and the collapse of Switzerland's Credit Suisse into the arms of its rival UBS. However, the US and Swiss banks that went down were badly run institutions that took too much risk, while the US lenders faced much looser regulation than their European and British domiciled equivalents. Nor were UK bank shares trading as expensively relative to book or net asset value as their US peers, so this may help to explain some of the difference in share price performance. While another key factor in HSBC's favour has been the reopening of China and Hong Kong after 3 years of lockdowns. Both are big earners for the bank. When it comes to HSBC's first quarter numbers in particular, analysts and shows will look to 4 key items. The first is loan and deposit growth to see if the run on US and Swiss banks has prompted any deposit flight or even driven money toward global megabanks like HSBC. The second is credit and asset impairments and whether there's been any increase there, thanks to a slowing economy and higher interest rates. In Q1 2022, HSBC took a $647 million hit on its way to total credit impairments for the year as a whole of $3.6 billion, the second highest number since 2015. Analysts are forecasting $4.1 billion of impairments for 2023 as a whole. The third number is net interest margin, and whether competition from other banks or high returns on cash and money market funds is at least partially offsetting the benefit of higher interest rates. HSBC's net interest margin rose from 1.26% to 1.74% from Q1 to Q4 last year. And then look for any unexpected litigation or conduct costs or fines, which have already really been modest for the last 2 years or so. All of that quartet will then shape the headline pre-tax profit figure, where the consensus for the first quarter is $7.5 billion compared to $4.2 billion a year ago. For the whole of 2023, analysts expect $32.7 billion compared to $17.5 billion in 2022. Now, HSBC is reverting to quarterly dividends this year, so watch out for the figure there. For 2023 overall, analysts are looking for 53 US cents a share compared to 32 cents in 2022. Remember that HSBC is also considering a special dividend once its Canadian business has been sold, and Chief Executive Noel Quinn and the board are also weighing up further share buybacks. A decision is expected there alongside the second quarter, or along these results, I should say, in the first week of May. And last year, HSBC ran $2.3 billion in buybacks. More strategically, watch out for any comment on the long-awaited sale of the French unit, which may now be in jeopardy, and also any comment from Mr. Quinn with regards to the pressure from major shareholder Ping An Insurance to even break up the bank and spin off the Asian assets. Hope that you and your families are on good health and good spirits. Thank you for watching, and I look forward to seeing you again next time.